I think that people are clearly on edge and are reluctant to make any significant decisions until we get better clarity as to where the tariffs are going to end, where that situation is going to end. Once we have more clarity to that, you can then go back and see the markets will react, they'll adjust, the Fed will react, it will adjust, and so will companies in terms of how they're going to invest, including my insurance clients and including the liquidity clients.
We don't know how it's going to end, but I'm curious if you've mapped likely scenarios for how they'll end. What do you think is going to happen?
Well, we do map scenarios, and so first I'll stick with the insurance industry, which is very well capitalized and not levered in the sense that they're not over their skis. They don't hold a lot of equities on the balance sheet, so the equity market volatility that we've been seeing is not creating a capital strain. They are primarily fixed income investors, and by the way, we're seeing the intermediate and long end of the curve rise. We're seeing credit spreads widen. So on reinvestment, that's a pretty good situation, as long as it just doesn't continue to cascade into something much more significant.
Even though, Mike, even though it's good for the longer term, for people who are reinvesting in bonds, you have insurance clients that are holding long-term bonds, and 10-year, 30-year notes are really blown out at this point. Are they suffering through a lot of pain because of it?
Yeah, so Sonali, you're absolutely right that on a mark-to-market basis, these bonds have lost value. But most of these institutions don't have to report on a mark-to-market basis. They're able to hold their bonds to maturity. So really, they are more benefiting from the ability to reinvest at higher yields than what's been happening to the current holdings. Not the same thing being true for hedge funds, example, or other institutions that are marked on a daily basis may have to provide collateral as their asset values are dropping. But that's not the case for the insurance industry.
But do they feel that there's a certainty that this does get resolved sooner rather than later? I think I love your interview you did with Boaz Weinstein, who I thought was assessing the situation and saying the thing is here, we have a president who's in for just under 4 years here, and that he said the uncertainty genie is out of the bottle. So do we continue to, in your view, and you've got to think about short-term, longer-term, medium-term, that uncertainty will be with us throughout this tenure?
I think uncertainty will be with us, hopefully not at the level that we have right now. And again, it's are companies in a position where they're forced to act or not? And to the extent that they're not over-levered, they're not forced to act, they could sit, watch, and look for opportunities. And I could tell you—
Are they nervous at all?
Oh, absolutely.
Okay. Keep going. Sorry.
So I would say, when you game plan out, right now this has primarily been an equity market event. Concerns that it becomes a bond market event. Rising yields are not that much of a problem. Draining liquidity becomes a problem. So there's a concern or a watch for that. Also, I would say for our insurance clients, they are long-term holders of corporate debt. How are those corporations going to fare? And certainly some corporations are going to be much more affected by tariffs, which would weaken credit. Others are immune to it. So we and our clients are doing a lot of work right now, going literally bond by bond, security by security. What is the sensitivity to the tariffs or not?
Well, on a micro level, some of that uncertainty has already led companies on a case-by-case basis to pull guidance. CarMax today, certain financial goals that it's just not giving. Delta earlier this week. You mentioned a lot of uncertainty, and I know yesterday Goldman Sachs rescinded its call for a recession this year. Are you seeing signs of a recession?
So let me say this. So one of the things we want to talk about was the survey. First, I would say on the insurance survey—
it's a 14th annual global insurance survey, 405 companies representing over $14 trillion in balance sheets assets combined. That's a lot.
That's a lot. It's about half the global industry's asset base. I bring that up because one of the questions we said is, what are you concerned about? And that question they got absolutely right. They're concerned about inflation. They're concerned about geopolitics. They're concerned about tariffs and market volatility.
Welcome to our world in a nutshell.
What they didn't get right, and nobody did, was the magnitude of the tariffs and the implications for that. So they didn't see recession this year. That view is changing, including at Goldman Sachs and within our clients. They thought the equity markets would be well-behaved, not rip-roaring, but well-behaved. That view is changing quite dramatically. But they also thought that rates had peaked and would be coming down slowly, both at the short end and the long end. And I still think that that's the prevailing view. So this backup in longer-term rates is looking like an investing opportunity. None of our clients have been selling or directing us to sell on their behalf. They are looking for opportunities to get into the market, but they're not in a rush. They want to see how things settle out. Once they see how things settle out, then they'll know where to put capital to work.
You mentioned that you're looking bond by bond right now. And the reason that's so interesting to me is because you're already seeing somewhat of a capital markets freeze. And if you're worried about corporate debt at all in this environment, what does it mean for the way people have confidence in investing in corporate debt in the future, in new issuance, for example?
Yeah, so Sonali, that's really going to be industry by industry, case by case, and that gets back to this uncertainty. Until we know how this unfolds, and it may not unfold to a point where we have definition. This is the way it's going to work. You've elevated the amount of uncertainty, which is elevating the amount of risk. I need to get paid a bigger risk premium to hold any of these instruments, and that's why we see credit spreads widening out.